Hey everybody, welcome back to another edition of 5 Question Friday, where I do my best to answer questions you all have sent in. 5 great questions today. Let's get started. Here we go. So number 1, how do we assess if you have an investment advisor, they're managing your portfolio, how do you assess whether they're doing a good job or not? Question 2, is it possible to both protect our nest egg in retirement, but also get some amount of growth to try to keep up with inflation? How can we think about that? Number 3, can a tips ladder mitigate sequence of returns risk? We'll cover that and what all those things are. 4, should we ever sort of reset our withdrawal strategy in the middle of retirement? And then finally, number 5, are free dinner investment seminars or other sort of portfolio reviews ever worth our time? So those are the 5 questions we're going to tackle in today's video. If you want to send in a question, subscribe to the newsletter. There'll be a link below this video to do that. It's free, goes out every Sunday morning. And then just hit reply to any email you get from me. I don't always respond, but I do read them all, I promise. I get to them. And yeah, that's how people send in questions. All right, so back to the questions. Number 1, how do we assess an advisor's investment portfolio? This came from Jeff. What are the most valid benchmarks for assessing your advisor-managed portfolio? This turns out to, in some cases, to be more difficult than you might think, and here's why. Some advisors might put you into just a handful of, say, index funds. Maybe they've got 4 or 5 of them in your portfolio. In that case, it'd be very easy. I mean, for starters, you can basically just understand that your portfolio, based on whatever the asset allocation is that you and your advisor have decided on, is following the market minus any fees your advisor charges, because you've just got index funds. But particularly advisors that charge 1% or even more, they don't tend to put you in 3 or 4 index funds. They tend to put you in 10, 15, 20, 30, 40, I'm not kidding, funds, some actively managed, some index funds, but just a complete complex mess of a portfolio. And so how do you compare that to some benchmark? It's incredibly difficult. So, but it can be done. And so that's what I want to walk through, to spend a few minutes sort of talking about the tools you might be able to use and how you might do that. So let's go back to the computer. And what we're going to start with is, I actually Googled, I wanted to get an example of a complex portfolio. I don't know, this was from 3 years ago. This is just a person in the Bogleheads Reddit forum. And you can see they've got this portfolio here, and there are different tickers of different funds. Now, the first sort of step, in my view, is to figure out what the closest index fund alternative is to each of these funds. Now, keep in mind, some of the funds your advisor may have you in might be index funds, but for actively managed funds, what's the closest index fund, the low-cost index fund that's closest to the actively managed fund your advisor has you in? Now, I'm going to show you some tools to try to figure that out, but for me, step 1 would be, hey, advisor, I would like you to send me the closest index funds to each of the funds you have me in. I mean, put the work on them. Particularly, hey, if they're charging you 1%, are you kidding me? Yeah, make them do the work. That's the first thing. And if they say no, or they kind of just, I was going to use a curse word, I won't, just mail it in, don't give you a really full answer to your question, then maybe you need to find another investment advisor. But make them do it. Okay. But you can also do it on your own, and whatever they give you, you probably need to check. So there's a couple of ways to figure this out. The first is, we could go to the fund itself, and it will tell you, most funds will say, hey, we're trying to track a certain index, not an index fund. They won't give you another fund. They'll give you an actual index, like the S&P 500. And then you could try to find a fund that matches whatever index they're tracking. So that's one way to do it, and maybe the starting point. The thing you have to keep in mind, though, is the fund, the actively managed fund, might not actually do a great job of tracking that particular index. It may be more of a general guide for that fund, but not really tracking it. The other thing you could do, you could just ask ChatGPT. Here we go. What index fund most closely matches Let's see if it comes up with anything. I've tested this before and it actually came up with some answers. We'll look at that in just a second. The other thing we can do while it's answering that for us is go back to this fund. What is it? EBNGX. I've never heard of that. We can put it in here. EBNGX. I think it's a bond fund. No, yeah, Emerging Market Bond Fund from American Funds. Okay. So we can look at it here and we can go to the portfolio and we can understand what it invests in. Now, this one's tricky because it's an emerging market bond fund, but we know that now. So we could just Google emerging, can I type here markets, bond index fund. I don't know if Vanguard offers one. Let's see what we've got. Here's one, Vanguard Emerging Markets Government Bond Index Fund. So we might use this to compare with the fund that our advisors put us in. Now, I've come back to ChatGPT. This is their new one, GPT-5, and it's given us some options. Now, this emerging market, VWOB, I wonder if it's the same thing as this. Sure enough. So ChatGPT found the same fund that we found. So again, you can come at this a couple of different ways. Now, once you know what the closest index funds are for each of the actively managed funds that your advisor has you in, you want to create a portfolio using those index funds with the same percentages, right? And it'll give you a rough idea. It may not be perfect, but it might be close. So how do we do that? Well, I would probably use Portfolio Visualizer. Now, if you're using the free version, as I am, and you go to Tools and you go to Backtest a Portfolio, which I guess is where I was to begin with, you can put in tickers. Now, the downside is for the free version, you only get 10 years worth of data, but maybe that's enough. So for example, and let me just clear all of this out, and we could put in these two funds. So going back here, it was EBNGX. So we can put that in. EBNGX. Here it is. We'll just, and for now, of course, you would put all the tickers in, but we'll just assume this is the only one we're going to look at. And then I could put in the Vanguard ticker. Now, it won't surprise me, by the way, in this case, if the actively managed fund does pretty well because of the asset class, but we'll see. And again, you'd have whatever funds, you'd have, more than this, of course, but this is just as an example. And let's see here. Why is that not working? Oh, here we go. Analyze portfolio. And we can look at this. Now, this goes back to 2018, so they don't have quite 10 years of data. And that's because this emerging market fund from American Funds has somewhat limited data. And we can compare them. We can look at results. So yeah, they slightly outperformed the index fund. Now, again, whether that will continue, who knows? It's only 10 years of data. And this is just one fund. But it would allow you to compare, once you put in all the tickers, the total portfolio. I would look, by the way, not just at the compound annual growth rate, which is this line here and here. I would also look at standard deviation, which is a measure of volatility. All things being equal, we'd prefer less volatility. In this case, the actively managed fund is slightly more volatile, but not by much. And so that, to me, I would look at this and say, well, in this case, the actively managed fund outperformed a little bit, and that's on an after-fee basis. Again, that's just one fund. You want to do the whole portfolio. You could, I suppose, use something like Empower. This is a demo account, but you could connect all of your accounts that you have with your advisor, and then come into investing and go to allocation, and you would see, basically this screen, but obviously with different numbers. And you could then say, okay, I'm going to kind of reconstruct this allocation with index funds. Not in Empower, you could manually enter those index funds, but I would still probably end up back here as my tool, Portfolio Visualizer, as my tool to compare the two portfolios. I just think it's easier to use. Again, the free version is probably fine. Empower is free as well, but I think the downside here is it'll give you a great insight into your actual portfolio very quickly, and you can drill down to your specific allocations all the way down to, large cap value, for example. So I think it's a great tool. But when you're comparing your current portfolio with some hypothetical, index fund portfolio, I kind of prefer a portfolio visualizer for that purpose. And you say, well, Rob, that seems like a lot of work. Yeah, it's really the only way, I think, at the end of the day, if you're dealing with a complex portfolio, to know just how well your advisor is doing when compared to a low-cost index fund portfolio. Now, you can't expect it to beat, these index funds on an after-fee basis over a long period of time. It's just not going to happen, particularly when you add in your advisor's fee. So keep in mind, when you see returns here, 3.11%, for example, that's after the fund's expense ratio. But that, of course, doesn't count the fee your advisor's paying you. But you already know that, hopefully, and that's coming off the top. So that's just the way it works. But this would be the best way to do it. I will say you can't really rely on your advisor to give you the benchmark, or if you do, you need to be very skeptical. I don't mean because they're trying to cheat you in some way. It's just that I think you'll get some sort of benchmark that may not have the precision that you need. I've seen it a lot at big brokers. I've had conversations with folks who say, you're in this Vanguard fund. Our actively managed fund outperformed. Did you see that one? And I look at it and I talk to them and I say, Frank, his name's not Frank, but I say, Frank, have you looked at the asset allocation between my Vanguard fund and your proposed actively managed fund? You're comparing apples to oranges. And they're like, okay, I guess. Like, really? Anyway, that's how you have to do it. Yeah, you got to roll up your sleeves and do a little bit of work, but it's doable. And like I said, ask your advisor to do a lot of the work. If they're paying you more than charging you 1% or more a year of your wealth, yeah, they can earn it. Well, they probably can't, but you can at least give them some work to do. All right. It's one of those days. Question number 2. This comes from Rita. For those of us who are just entering retirement this year, which index funds are good to have to preserve our nest egg, but also grow to combat inflation? And then, considering Trump policies and tariffs, do the traditional old recommendations of stock and bond funds still hold? Now, I will say I considered leaving out that last sentence because it's kind of political, but then I thought, no, it's the reality we live in, and a lot of people have those questions. So I personally don't think the world as we know it has somehow fundamentally changed over the last 6 months. Yes, tariffs are a new reality. What the outcome will be, I don't know. How long will they stay in place? I don't know. I just don't know that. I don't know how you know it. The next president that comes in can change them, right? So for me, I don't think there's been some fundamental change between stocks and bonds per se. At any time, some can be expensive, some can seem relatively inexpensive, but I haven't sort of moved away from using some combination of stocks and bonds to manage the volatility of our portfolio. So the question becomes, all right, well, how can we protect ourselves, but also have growth? Because in retirement, you do need the growth of stocks in most cases to generate enough returns to get you through high inflation periods and just a long retirement. And let me visually show you what I mean. We're going to go to another tool we talk a lot about. This is FI Calc. Again, I'll leave links to everything I'm showing you below the video. This tool is free. And what we've got here, we're assuming a 30-year retirement, $1 million portfolio, 80% stocks, 15% bonds, and 5% cash. I think that equals 100%. And right now we've got a 4% withdrawal rate of 40,000. By the way, we could change this to 100,000 and make this 4,000, and we'll leave it there. The point I want to make is the portfolio value is not what we're focused on. Obviously, in real life, it's pretty important. But what we're really focused on is what percentage we're taking out in year one. Now, I'm using what's called a constant dollar approach. That's what Bill Bingen used to come up with the 4% rule. Again, this is just modeling retirement. It's kind of like economic models. I like to say none of them are correct. They're all wrong. Some of them just happen to be useful. I think this is one that's useful. And okay, so if we wanted to get super quote unquote conservative, we could say, you know what, I'm scared of stocks, so no thank you. We're going to put it all in bonds. Safe, quote unquote, I'm going to put my put me up here. Excuse me. I want to air quotes. I'm going to put it all in safe bonds, right? Because they don't fluctuate like stocks do, which is true. At least the kind of bonds we talk about, U.S. government bonds, investment grade corporate bonds. Anyway, 0% for cash, and our success rate plummets from 96% to 49%. So it turns out that bonds, in one respect, aren't safe at all, at least not 100% bonds. Why? Because they don't give us the returns we need to fund a 30-year retirement and to get past high inflationary periods. Yes, in the short term, inflation can pummel stocks. But remember, when there's inflation, what's happening inside a corporation? Well, they're raising prices, right? That's what causes inflation. And so, but of course, their costs are going up too. So it's not a win for corporations, but they are over time dealing with inflation in ways that longer term can actually help investors more than quote unquote safe bonds. And so if we actually look at the failures in this simulation, notice, by the way, recently it still succeeded after 30 years because of the more or less the big bull market we've had in stocks and the declining interest rates in bonds over the last 40 years. Of course, there's been hiccups along the way for sure. But then, my goodness, look at this. I mean, it's just a mess. All those red X's means we failed. We didn't make it to 30 years. All right. So how do we balance this? Well, the first question is, how much balance do you need? I can imagine a retirement that actually could have a 100% bond portfolio and survive 30 years. What's that look like? Well, how about a 2% withdrawal rate? We'll take this to 2,000. Maybe you don't need to spend 4% of your portfolio in year one and adjust for inflation after that. Maybe you can just do 2%, in which case, wow, we're at 100% success rate, right? So maybe you don't need to take the risk. We could even bump this. I'm going to guess that's going to be pretty good at 3,000, which is a 3%. Remember, we got a 100% portfolio, or $100,000 portfolio. So $3,000 withdrawals, a 3% success withdrawal rate. We're at 90%. I would be okay with that. Maybe you will be too. But you get the idea. Your withdrawal rate may be such that you don't really need to take huge risk because maybe you're relying on Social Security, maybe a pension, maybe you've taken some of your nest egg and bought a fixed annuity, whatever it might be. So that's the first thing to keep in mind. Now let's go back and let's say, well, we're actually starting at 5,000. Wow, that just plummets it. Yeah, 100% bond portfolio for a 30-year retirement isn't going to cut it. So the question is, well, how much stocks do we need? Well, let's change this. We'll go 50% stocks, 50% bonds. Is that enough? That gets us to 70%. Now remember, we're using a 5% withdrawal strategy. 70% might be okay with you because you may say, well, Rob, I'm fine with that because I can cut back my spending if I need to. Some of this spending is not on needs, not just to keep the lights on at home, but for things I want. And I probably will cut back on some of those wants as I age anyway. So I'm okay with 70%. Or some of you may say I'm not okay, really. And so I either need to lower my withdrawal rate or maybe change my asset allocation possibly and take on some more risk. We could test other things. How about 75% stocks, 25% bonds? Does that improve on our 70% success rate? It does, jumps it by 10%. But now to Rita's question, you're taking on more risk. You've now got a 75% stock portfolio, 25% bonds. I'm perfectly would be comfortable with that. But a lot of retirees wouldn't be, and I get that. So at the end of the day, I think you need to figure out what asset allocation you're comfortable with. Once you know that, you can find the funds that match that allocation. I'll give you a couple of examples, but before I do, I want to stress something. This calculator is using historical data. It's not using a Monte Carlo simulation. Now, I think that's perfectly reasonable. In fact, in many ways, I think historical analysis probably gets us better results than Monte Carlo simulations. And I think often they're not that dissimilar to begin with. So I think it's good to look at both. But you do have to stress, this is not a guarantee that with this asset allocation and this withdrawal rate and this portfolio balance and this retirement planning period, it's going to work out just like you see the numbers on the screen. This is just based on historical data. The future could be significantly different. I guess there's no way to know. That's why I always like to have some kind of margin of error in my planning, but I want to stress that. So how can we find a portfolio or a fund that meets, let's say we just go back to the traditional 60-40. Let's say we go 60% stocks, 40% bonds. That gets us a 75% success rate. Maybe we're okay with that. Maybe we can adjust if things don't work out well. How can we find that? Well, I like index funds, and you could use a balanced fund, meaning a fund that owns stocks and bonds, particularly if you're inside a retirement account. And one example would be life strategy funds. That's just the name Vanguard has given them. In fact, we can find, they give you four allocation options. One happens to be 60% stocks, 40% bonds. Here it is, VSMGX. It's not the only option, of course. Wellington Fund would be another one, which I believe is close to 60-40, which is a Vanguard fund. It's actively managed, but very inexpensive. And so, and you could find Fidelity funds, Schwab funds. I mean, there are other options that you could use. I'm not recommending this one over the others, but it's not that hard to find a balanced fund that meets the asset allocation that you want. Or you could just use 2 or 3 index funds to get the exact allocation that you want. Obviously, a single fund is much easier to manage, and that's what we use. We don't use this particular one, but we use a Vanguard target date retirement fund in our traditional retirement accounts. In our case, they happen to be a solo 401k, and it's just simple. It's one fund. We use the same fund in both of our accounts, and it's very easy to do. And I've did the same process that you've seen here. I figured out what overall asset allocation I want, and then I figured out, okay, to achieve that, what's the allocation I need in our 401ks? Okay, I've got it. In our case, it's 30% stocks, 70% bonds. Again, that's just for 401ks. Our overall asset allocation is around 70-30 right now. And I found the fund that worked. So I did exactly what I'm describing here in response to Rita's question. Hope that helps. Okay. Number 3, can a TIPS ladder mitigate sequence of returns? This is a great question from RC. Can you explain how a 5-year TIPS ladder or treasury ladder can help mitigate sequence of returns risk? Okay, so we need to talk. Sequence of returns risk is just the risk that in the first, we'll call it 5 to 10 years of retirement, you have bad stock markets, particularly if you have high inflation, your portfolio takes a beating, both because the market's down, and particularly with high inflation, you're having to spend more and more and more of your money every year just to stay afloat, just to keep, not to spend even more than maybe you plan, but just to continue to have the same inflation-adjusted spending that you've enjoyed. And now the thing I want to stress is, with the sequence of returns risk, the issue is typically not you'll run out of money in 5 years or 10 years, unless you're spending a truckload, but it's that your portfolio will take such a big hit. And inflation will not only increase your spending in those first 5 to 10 years, but inflation sort of bakes in and you're spending more and more for the rest of your retirement, even if inflation moderates. But if you increased your spending and costs went up the first 10 years, even if it moderates, you're still already at an elevated level at the end of that 10 years. So yeah, maybe year 11 is only 2 or 3%, but it's on top of a much higher spend because of the inflation you had the first 10 years. What can happen is you can run out of money. Again, it might not happen at year 10, might not happen until year 20, but it can be hard to dig yourself out of that hole. And we can see that, by the way, if we go back to FI Calc and I put in, well, we'll just look at what we've got here. We don't have to change anything. Let's just find a year that failed. We'll go to 68. That was a rough year. And you can see, we started in 68 and, by 78, which is right here, we still had money. We didn't run out yet, but, we ended up running out roughly after less than 20 years. And why is that? It's exactly for what I've described. In the end of 1960s was a bear market, 73, 74 was a bear market, and then, of course, we had high inflation in the 70s and early 80s. And there you go. That's a picture of sequence of returns risk. So What's a TIPS ladder? Well, TIPS is a Treasury inflation protected security. It's a U.S. government bond. You get a lower yield than a regular Treasury, but they adjust the principal balance of your bond by the rate of inflation. So you get a lower yield, but you get this inflation adjustment. So it's inflation protected. And so a lot of folks like TIPS. I like TIPS. I don't invest my fixed income portfolio entirely in TIPS, but there's a fair amount of it is in TIPS. I think it's a great tool to use. And you can buy individual TIPS and create a ladder so that, say if it's a 5-year ladder, like RC asked in his question, you would have some number of bonds that mature each year over 5 years, plus you're getting the interest each year. And so you can get, let's say you need $20,000 a year, you can build a TIPS ladder that's going to give you $20,000 a year plus inflation. We don't know what the inflation will actually be. For a TIPS ladder, it doesn't matter. If it's 10%, you're going to get that 10% adjustment. And if you go to tipsladder.com, that's a free tool. I'm not associated with it, but I've looked at it on the channel before. You can easily build a TIPS ladder. And so the theory, I think, is this. We'll just spin the TIPS ladder over the first 5 years, or you could build a 10-year TIPS ladder, and we'll leave the rest of our portfolio alone, and we'll use this TIPS ladder to get us through those first 10 years, that sequence of returns risk period. Phew! We get through that 10 years and we're good, right? Well, not so fast. So a couple of things here you need to think about. First of all, as you're spending the TIPS money, what are you doing with the rest of your portfolio? Which, by the way, could include other types of bonds, right? And stocks. My question is this: are you rebalancing your portfolio every year or not? And even within your fixed income, do you have some kind of allocation between TIPS, maybe your 5-year TIPS ladder, and not what they call nominal bonds or just normal Treasury bonds? Is there some allocation between those two as well? And are you rebalancing every year? Now, I think for most folks that think of a TIPS ladder as a way to deal with sequence of returns risk, they're probably not rebalancing. Because if you're rebalancing every year, by the way, the TIPS could be great, and a TIPS ladder perfectly part of a portfolio, but it's in some way no different than just a normal portfolio that you have, and you could use TIPS funds instead and just rebalance it every year. After 10 years, assuming things have gone okay, yeah, you're probably okay, but you won't know till you get there. Part of it depends on what your initial withdrawal rate was. If you think about sequence of returns risk, if you started an initial 4% and adjust that for inflation through retirement, at least as a way to model what your retirement might look like, do you have sequence of returns risk? Well, the answer is no, at least based on history, right? That's what's Bill Bingen's research. History says you won't run out of money over 30 years. Now, of course, we could all imagine a different kind of future where you would run out of money. Sure. And how do you evaluate that? We just have to evaluate it year by year. You get to year 10, you can evaluate it. How do you do that? Well, one simple way would be to come back here to FI Calc, put in what your portfolio balance is. We'll just say 500,000. And let's assume now you're planning for 20 years. And your withdrawal is, I don't know, 26,000 that year. What's your success rate? It's 94%. I mean, you could look at it as simple as that. You, of course, could use something more sophisticated like Boldin or Projection Lab, retirement planning tools. But because we don't know the future, I can't predict it. If we want to say, well, what's the past look like? Yeah, 4% is safe. It's never failed. But here's the thing that I want to stress. I love TIPS. They're great. I have TIPS in my portfolio, but we shouldn't view them as some special kind of investment that can somehow get us beyond the sequence of returns risk. They just can't. If we do a 5-year TIPS ladder and we leave our portfolio alone, don't rebalance, which is I think what a lot of people do, you're going to, of course, be okay for those 5 years. You've got your money. It's adjusted for inflation. It's all in TIPS. You may have other money like Social Security, but we're talking about the money you want to pull out of your savings. What will it look like at the end of 5 years for the rest of your portfolio? We don't know. Yeah. If we have a 2000 to 2002 kind of market, your portfolio is going to be down. And if we have a late 70s kind of inflationary experience, your spending is going to be up a lot, right? And so you could come out of that 5 years or 10 years, and you may have some tough decisions to make. So in my view, I think a tips ladder is a wonderful tool to include in your retirement planning toolbox. I don't own a tips ladder, but I could see buying into one at some point in our retirement. We just don't need to right now. But I wouldn't think of it as some magic bullet to avoid sequence of returns risk. Now, I know I've spent a time on this, but I want to hit one other thing. There's a different way to think of a tips ladder that I think can, in a way, deal with sequence of returns risk. And it's this. Rather than thinking about your spending as one lump sum, break it into two. Spending you need to have just to live, your basic spending, keeping the lights on, your family fed, and your Netflix subscription, which we all have to have. That's a need, I think. But seriously, just your true needs. And then you have your wants, going out to eat, traveling, your hobbies, whatever. They may be important to you, but if we really hit a really bad situation in the world, those would be the first things you give up and you would survive, right? So then the question is, for the things you need, how much of that amount is in some form of guaranteed income, at least as guaranteed as we can get in this life? Social Security, pensions, maybe you've bought an annuity, and I would include in that a tips ladder. So if you have your needs taken care of through retirement, or a large percentage of them, doesn't have to necessarily be 100%, but a large percentage of them, including through a tips ladder, I think that helps insulate you from the sequence of returns risk. Now, it could still affect you, right? On the wants side, right? That's where the sequence of returns risk could hit. But at least you're going to eat and keep the lights on. And so in that sense, I think a tips ladder can be an excellent retirement planning tool. I think I kind of, did I say too much on that question? I don't know. I feel strongly about it, but it's a great question, RC. Whew. Okay, should we ever reset our withdrawal strategy? So I'm going to show you Edward's question right here. So it's here. I'm not going to read it all, but it's a very clever email. He should be a novelist. Excellent. He even uses words I had to look this one up to pronounce it correctly. I'm not even going to try. In any event, here's his basic question. He says, I want to spend a lot of money. It wasn't planned in my retirement. I'm going to pull out a chunk of our retirement savings to spend it. How do I think about that in terms of retirement planning? Do I reset my withdrawal rate? In this case, it happens to be, I don't know if this is just completely made up or if Edward is going to buy a home in Spain, but that was his question. Now, it's a great question. We may have other things. Maybe you're going to pay for a daughter, granddaughter, or I don't know why I limit it to daughters, son, grandson's wedding. Maybe you're going to pay for a child or grandchild's education. It's going to be a big chunk of money. How do we think about that in terms of our retirement plan? So again, we'll keep it simple and then maybe a little more involved. We can go back to retirement calc, right? We can look at this and we'll just say, since Edward's thinking about a home in Spain, let's assume he's got 2.5 million bucks. Is that 2.5 or did I put 25 million? I think that's 2.5. So that would be about $100,000 a year if you do the 4% rule. And we'll go to 30 years. Yeah, it gets us to 96.8. So I think he indicated they're fairly comfortable. So let's assume for the moment he only needs to spend $75,000 a year. So he's got a 100% success rate. So one way you could do it is you could say, well, I'm going to do an extra withdrawal. We're going to say home, don't have to give it a name, but why not? Home in Spain. I don't know what homes in Spain cost, but I think I want to take out 20%, which is 500 grand if my math is right. I'm not going to adjust it for inflation. This is a one-time expense, and you can put where it's going to be. We'll just leave it at 5 years. Maybe he's researching, he's going to buy it in 5 years, and we're only going to withdraw it for 1 year. It's a one-time purchase. Boom. And right now he's still okay, according to the history. Now, you could do this in Boldin, right? Let's see here. I pulled Boldin up. It would just be an expense, one-time expense, and you could just put it in, right? Again, we could do home in Spain and the amount. You'd want to adjust this for inflation if it's from 5 years. I won't keep filling it out, but you can do this in Boldin. You can do this in Projection Lab. You can do this in Prelana. But we can do it here. And at least based on history, right? Remember that caveat, we can get a rough idea of whether our plan is still going to be okay. But there is one thing that I think you need to really think about, particularly if you're going to spend your money on something that increases your expenses in retirement. If it's a wedding, it's a one-time purchase, hopefully. I don't know if maybe there are expenses with the new family. I don't know. But we'll assume, we'll do college education. It's a one-time purchase. But with a home, it's not. Now you've got insurance. You've got, I assume they have real estate taxes in Spain. I don't know. But you got real estate taxes. You've got maintenance. And if you ever want to visit this home you've bought, you've got to, I assume, fly there. I guess you could take a boat. But you got to get there. That could actually crush a retirement plan more than the initial purchase. So you've got to think about that. Now, again, we can go back. It's not hard to do, right? Even in the free tool FI Calc, we could add another withdrawal. We could say home expenses, and we could say the annual amounts. We'll just say it's $12,000, $1,000 a month, whatever it might be. We're gonna this I would adjust for inflation. It's going to start at the same time, and you add it in. Now, in this case, just because of all of the assumptions, we're still at 100% success rate, which kind of bothers me. Let's go to 85,000. Okay, that looks better. So the point is, it's a great question from Edward. I do think you can sort of reset and think about your retirement plan the way I've walked through. Again, if you're using retirement planning software, you just put that one-time expense in. If it's a home and it's going to increase your annual expenses, you put that in. It's very easy to do, and then you can see your success rate. But yeah, if it's something like real estate, you got to realize it's not just the purchase, right? It's all the other expenses. Okay. Last question. Are free dinner investment seminars ever worth your time? This was from a viewer named Rob, and you can read the email there. By the way, go Bucks, so I'll give him an OH. Hopefully he's saying IO in response. So here's my take. So I went to, as many of you know, a free investment dinner that one of the brokers I use put on. And I'm glad I went. Now, I didn't agree with most of what the person said in terms of their investment strategies. They're complex, expensive, nothing I would ever invest in. But I wanted to go to one for the experience. And I met some very nice people. The dinner was lovely, and I don't regret going. But if you're actually trying to seriously get a review of your portfolio, here's the thing I think you need to watch out for, and that is a sales pitch disguised as a portfolio review. And so how do you avoid that? Well, you get a portfolio review from someone who's not trying to sell you investment advisory services. It's as simple as that. It's the only way to know that you're getting that person's unbiased, I started to say honest, but I'll say unbiased assessment of your portfolio. If someone's giving you a portfolio review and they want your business, they want to sell you their investment advisory services, it doesn't mean that what they're saying is invalid or even bad or wrong. It could be quite smart, but you're not going to know. And they do have a vested interest in getting your business. So I think if you truly want a portfolio review, you need to go to someone who's not trying to sell you anything other than a portfolio review. Now, for me, I would probably pick Mark Zorro. I don't have any financial interest with Mark. He's at Plan Vision. I've talked about him in the past. I've used him. I know how he thinks. I know he's a big believer in index funds. And he's very reasonable cost. I have a list of low-cost investment advisors that I have no financial relationship with at all on my site. I'll leave a link to that below this video. But if you want to just go to an investment seminar, you want to get a good dinner, maybe meet a few people, I think that's perfectly fine. Like I said, I enjoyed my time there. But if I want a true review of my portfolio, you need to go to someone that sells portfolio reviews, not someone that sells investment management for like a 1% AUM. Because you're going to get a sales pitch disguised as a portfolio review, and that's just not what you need, in my view. So there you go. Great questions as always. As I said, I'll leave links to everything that I showed you, plus that list of low-cost financial advisors below the video. If you have any questions, leave them in the comments below. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.